Hey everyone, the Supermicro stock is slated to report fiscal year 2024 earnings on April 30th, and investors are curious if they should buy the stock before those earnings results. So I'll answer that question here. I'll also preview what to expect from Supermicro in the upcoming quarter, and I'll discuss a little bit about why the stock price crashed by 20% after the company announced its earnings but didn't give preliminary guidance. So I'll talk a little bit about that as well. So let's jump right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so when Supermicro made this listing and said that they're going to deliver earnings on April 30th, the stock price crashed by over 20% on that day. And primarily because in several of its previous announcements of this kind, it provided preliminary results to investors. And when it didn't do that this time, investors feared the worst. And so they sold off the stock and the price crashed by more than 20% in one day. That was partly due to the missing preliminary results and partly due to an already inflated valuation. As you might already know, Supermicro stock is up significantly already in 2024. So any excuse of any kind of letdown or setback is going to send the stock price crashing. So that can partly explain those figures and why the stock price fell. Of course, I made a video about that. I'll link to it at the end of this one if you want a more detailed analysis on why the stock price fell due to the missing preliminary results. Now, heading into the previous quarter, net sales absolutely exploded for Supermicro. 3.66 billion versus 1.8 billion in the same quarter last year. So sales more than doubled year over year. Gross margin was not as impressive, 15.4% versus 16.4% and 18.7% in the same quarter of the prior year. So gross profit margin actually fell while revenue exploded. This was a stark contrast in what I've been talking about ever since these numbers came out on January 29th, is NVIDIA is experiencing a surge in sales, but those are coming with expanding profit margins and booming profits and booming cash flow. With Supermicro, that wasn't the case. And so that was one, if you could pick out anything of caution with Supermicro, that's been the case since the company surged onto the scene and became one of the most popular stocks in 2024, given the popularity of artificial intelligence and given how Supermicro is capitalizing on that trend. I highlighted the cash flow, and the cash flow used in operations for Q2 was 595 million. So instead of generating cash flow, they had to use cash flow. And that was a lot different from NVIDIA, which also experienced a surge in cash flow. Supermicro, not so much. Now, it's common for companies that grow this rapidly to experience negative cash flow because they first have to build that inventory and then they sell the inventory, and they might give terms like 30, 60, or 90 days to get money back from their customers. But it's another signal that demand for Supermicro isn't as strong as the revenue number would suggest, isn't as strong as NVIDIA. Now, they're incredibly good, don't get me wrong, but those expectations I felt were overblown, right? Those expectations were so good that investors thought, man, this is another NVIDIA here. And it's not the case, partly because management has made a different strategy here. They had to offer better terms, better prices to sell these products versus NVIDIA, which is experiencing their customers practically begging NVIDIA for their products. And NVIDIA is charging premium prices, getting the exact terms that it's looking for, and there's a wait list for NVIDIA's products. So I know a lot of investors are comparing Supermicro to NVIDIA, thinking it can experience those kinds of gains over the next several years. I just want to temper those expectations a little bit. Supermicro is doing incredibly well, as I have said, but it's just not on the level of NVIDIA. It's nowhere near on that level. So those revenue numbers were so good that they had to raise their 2024 outlook up to 14.5 billion at the midpoint. I'll talk a little bit more about that later. The company for the next quarter expects net sales of between 3.7 and 4.1 billion and diluted earnings per share between $4.79 and $5.64. Now, I would expect the company to beat these expectations, but if they don't, I fear what could happen to the stock price. There's already been so much optimism priced into Supermicro computer stock that I fear for what will happen if they should not beat these expectations, if they should not at least deliver 3.9 to 4 billion in revenue, if not even more, 4.2, 4.3, because investors are expecting the company to beat and raise their guidance. And that's been the case with many AI companies until recent days. Up until this quarter, nearly all AI companies I had been following kept reporting results that were better than expected, better than expected. Like everybody thought prospects were so good and they kept even beating those prospects. But the last few companies I've looked at, including ASML and Taiwan Semiconductor, their results suggest that it's not accelerating as it was in the previous quarter. It's still really strong, but it's not accelerating like it was 6 months ago, where it was like, man, things are even better than we thought, even better than we thought. That accelerating rate of growth has kind of slowed down if you look at ASML and Taiwan Semiconductor and some other expectations you've seen. And you've seen that in Supermicro computer stock, which is kind of tamped down expectations as well. So investors will be looking here to see what's happening. Is that rate of increase slowing down, or is this still tripping over themselves, still increasing at an increasing rate? So I highlighted that they experienced such great revenue that they increased their fiscal year 2024, which ends in June 30th, their revenue guidance from 10 to 11 billion. They raised that by nearly 4 billion, up to 14.3 billion to 14.7 billion. That's how strong their sales performance was, that they raised their guidance for the full year, which only has 6 months left, up by 4 billion. That's what led to a significant surge in Supermicro stock prices. That revenue came in so strong that they had to raise their guidance by nearly 40%, and that sent the stock price surging. But in the last month, it's down. It's down 21% in the last month. Of course, I recommended Supermicro computer stock as a buy around January 15th. But then around March, I told investors that the profits were so much in the stock to sell and take profits. So since then, I've had Supermicro as a hold. And going into the earnings results, looking at its valuation, it's now trading at a forward price to earnings of 24, which is still more than twice where it was trading at historically. So it's already incorporating the better than expected forecast, the better than expected business performance as a result of artificial intelligence. It's already more than doubled the valuation of the business, the forward price to earnings valuation. So I feel it's already stretched, and I feel the risks are massive heading into these earnings results, both to the upside and to the downside. I wouldn't be surprised if this stock moves by 30% up or down following its earnings results. It could move down 30%, it could move up 30%. That would be a probable scenario heading into these earnings results. And that means the risk is way above average here. So if I'm an investor, which risk would I prefer to take? The risk of missing out on an already expensive stock, or the risk of losing my money on an already expensive stock? And I would say I would rather have the risk of missing out. So I wouldn't buy here. If I miss out and the stock price soars after earnings, I'm okay with that. There's plenty of other stocks to consider. There's at least 25 more that I have on my list of top 25 stocks to buy that I would rather have than Supermicro Computer right now, even though I acknowledge it's a phenomenal company growing at over triple digits and demand for its products are through the roof. All that being said, the valuation has already incorporated much of those strong prospects in here. So I would say, no, don't buy it heading into these earnings. I'm keeping it rated as a hold here, and I'm updating that recommendation on April 23rd. I will, of course, update you after the earnings results, and I wouldn't be surprised if I upgrade the stock following the earnings if there is good news there on profit margins and cash flow and continued increases in customer demand. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.